we still have those 3 great questions that came in. Alberto, you're the 3rd question. We're going to start with David. Related to covered calls, but not really. David and I had a conversation this week. He says, Mike, we talked about covered calls already. And I like the way that's phrased there because of what we just covered. But he said, we talked about covered calls already. And I wanted to follow up on it. What do you think of a calendar spread on a stock such as Amazon selling an at-the-money 1 month from expiration and buying a leap call a year or 2 from expiration, also at the money? Okay, so calendar spread comes in 2 forms. I don't have it here, do I? Nope. All right, so let's go to other strategies. And if I don't see a strategy I want, of course, we're just going to clear out married call. And I'm going to add calendar call into the position. All right. There we go. Now, let's go to calendar call home. There's 2 forms of a calendar call that we show in PowerOptions. There's multiple forms of the calendar spread, but there's 2 forms we really show. The initial profit and loss chart is what's called a diagonal. Diagonal can be done 2 ways. What we show on PowerOptions is a reflection of a term that I hate, that I don't like to use, I should say, and that's the poor man's covered call. Buying an in-the-money 4, 5, 6 month or leap call below the current stock price, and then selling an at or just out of the money one. So instead of buying the stock and doing the covered call, I'm buying a in-the-money option to simulate stock ownership, and we get this type of profit and loss chart. There's proper structures to use. We have webinars on that. I'll point one out later for you if you're interested in the diagonal spread, the poor man's covered call, about criteria to use and so forth. This is referred to as a diagonal. Anytime you're using different expirations and different strike prices of call or puts, it's referred to a diagonal spread. A horizontal is what David is referring to. And that is the same strike spread, which gives us sort of a tent profit and loss chart with more of an upper and lower break even on both sides. Kind of looks like a butterfly, but it's skewed because of the time. Up front, I'm sorry, David, I brain freeze for a minute there. I'm going to be honest with you. I don't trade these. I don't like this structure personally, the horizontal spread. We're going to cover it for you. We're going to take a look at it for you. I personally don't like horizontal spreads within the same strike because I personally don't like an upper and lower break even, 2 ways to lose in the sort of market conditions that we've been in and we've seen over the past couple of months. You know, good August relatively, a weird slow decline in September, up and down volatile October, and now we're entering in November where we jumped up the past couple days. Is that going to continue or it's not? It's a little tricky. One advantage, of course, of the horizontal that David's asking about versus the diagonal, if I bought a deeper in the money Amazon call, is the cost. We have a much lower cost because we're buying at the money and we're also selling in at the money. If I bought an in the money, I might be paying as much as $400 or $500. That was actually a discussion I had on another coaching session earlier this week as well, looking at a poor man's covered call on Amazon, and the price total was about $400. Buying a 550 strike, I think it was February, maybe March call, and then selling the near-term November or December 1 or 2 strikes out of the money for about $110. So still $440 in one contract would put you at $44,000 cost basis. So David's going to have a much lower cost basis than what I was looking at previously in my discussion this week. But in any case, let's take a look at it. Let's go to custom spread, and we're just going to build an at-the-money spread as he asked, 1 month out in time. Roughly, you said 1 month out in time? Yep, 1 month from expiration. And a leap call a year. Let's just go a year out in time, not too far, because we might be talking about almost $100,000 to buy the at the money. In any case, let's use Amazon. We'll go exactly, well, we can go to standard expiration that's 42 days out, but let's just keep it 28 days out. Amazon, of course, I'm sorry, is currently at 3311. Okay, so we're going to take the at the money call. We're going to sell it. Sorry for the scrolling. A lot of numbers here. Go. All right, if we want to be at the money, we've got to use slightly in the money 3310, David. We could use the 3320, but I'm going to use the 3310. We're going to get about $130 for this at midpoint. Now, we're going to go to January 2022. November. Oh, there is a November. It's 1 year out. Let's just stick with that November, shall we? Why not? All right. So we're going to go to the November, 378 days out. And as I mentioned before, we've got to take the same strike. 33. Oh, shoot. That's one of the problems you run into here. But it's okay. We're going to use it. I'm sorry. The problem here is that in the leap out options, they only offer 50-point strike differences, David. So I'd have to use the 3,300 or the 3,350. Either one might be okay. But I'm going to buy the 3,300 at 524, and we're going to sell that near-term one for 120. So just like the diagonal spread I was working on with my customer for February to near-term November or December, we're going to have almost the same debit of $440, $430. So this is a little bit higher, but yes, we're going to sell the 3,310, David. We're going to buy the 3,300. We know our debit's going to be 400 some odd. Oh, just a little. It's going to be $392.32 debit for one contract, or $39,000 to put on this trade. I've got an upper break even of 3,601, and this is based on December expiration, and a lower break even of 3,100. And you might say, hey, that's not too bad at all. That's 200 points down before I hit break even and 300 points up. But let's look at it a different way. Okay, that's not too far percentage-wise from where we are right now at all, is it? Think about a stock trading at 3,311 instead of 3,311. Is it possible that in 30 days we might see the stock drop down to $31? Yeah, if it's a weak market, that's not too far-fetched. I don't think this is too far-fetched. And if we had a really good market, could we see it go up to 35, 36, 36.50? Possibly. Okay, so percentage-wise, this is not that wide. You have a high upper and lower break even. Yeah, you're not expected to hit the maximum risk on this position, but it is a possibility that the stock could fall so far that you could see significant drops in that position. This is a very neutral strategy. And all I'm saying right now, David, is the reason why I don't trade this particular strategy, and we'll look at another example here on Kraft in just a moment so I can sort of illustrate the same prices and what I feel is the risk on this strategy here. I personally don't trade iron butterflies. I personally don't trade short straddles. Sometimes I may use an iron condor. But positions that have a peak profit and loss chart and have, in what my opinion, are a tight upper and lower break even, I am not a fan of. Because in order to be profitable consistently on these positions, David, in my humble opinion, okay, it's based on management. Okay, it's based on that I am planning that I'm going to have to manage this. If it moves up, I'm going to have to manage this short call and continue that plan on that case. Maybe that is your goal, but it's more management intensive in that case. Okay, and at the same time, if it falls, okay, this one expires worthless, and no, my long option's not going to drop by $100 in that case. But this is not the structure that I like. It's very neutral, and these are not that big percentages away from the current stock price to see movement. Now, let's just take a guess here. We saw the market was down today, of course, a little bit. I don't know if Amazon was. Let's just go to the stock research. It's up 1063. Oh, sorry. Down 1063 today. Okay, great. That's nothing. 0.32%. Fantastic. It moved 80 yesterday. Okay, that's, a pretty significant move. 80 points is starting to get, drop down near my strike prices there. Not near my break even yet. We go back another previous day, it moved 192. 192 down in this point, or 192 up, would get me close to that upper and lower break even. That's a 6% move. Significant. I believe it was related to earnings. No, it wasn't. It was related to the election. The earnings were the week before. My apologies. Okay. And so in that case, the movement here, 1.46 is 43. A 6% move, of course, is 192. Going back, 192 movement up, we're getting close to that upper break even. We're falling away in profit, and you've got to start really focusing on managing that short call position. That's what's hindering your gain, is the short call. Now you've got to buy it back at 170, 185. I mean, if it's up at 35, you're going to be at 200, 240, 250. We're adding back into the cost basis in this case to try to pick a higher strike call or now have to move it out to January. Yes, you have the time to manage it. I don't prefer these strategies. Sorry, David. I prefer, for my sanity, David, I'm not going to say it's better long-term. Anyone can chime in with this if they want to. If you're trading the horizontal calendar spreads and you're having great success, I'd love to hear it, and David would love to hear it. I personally do not like the horizontal positions because it's a tight it's a tight upper and lower break even in most cases. While we're here, I know I bounced around a little bit. I'm going to go to Kraft, for example. I know, completely different stock, and I'm not saying that this is a good one to use for this strategy either, but I just wanted to show you the possibility. Kraft is at 31.54. Okay, so if I do the at the money 32 call a month out, 60, 70 cents, close to the same time frame. I got to go to January here, and we're going to buy the 30 strike. Okay, slightly in the money. It's not a true diagonal. It's really close to each other. This is more of a diagonal. But I had to use the different strikes on yours, David, so I'm going to have to use them here too. Okay, this one did not do as I expected. Okay, if I was at 32 and 32, it probably would have. But in any case, this one doesn't go into the negative. But you see the lower break evens at 28.70. That's about a 10% move. That does seem like a little bit more extreme. I'm kind of liking this more and more now, but I'd probably go to the 32.50 or the 33 in this case. The return looks good, and the risk to return, don't get me wrong. Let me go back to Amazon now. There we go. The risk return looks good. It's a 28% return, but the key to remember in a diagonal, David, or a horizontal is that profit, this high-looking profit that you see, occurs if and only if the stock is trading right at the short call strike price at expiration. We move up 10%. Okay, we move up to 3,600. That's 10%, right? We move up to 3,600, you're at a loss. You move up 5% halfway between the two at 34.50, which would be right here. You're at about a gain of 4,500, less than half of the 28% you expected to make. And of course, the same thing if we drop down to 3,200, you're at half of that projected gain you expected to make. Okay, that's what's risky with these these leverage positions. Is this 3 to 1? It's okay. It's 4 to 1. $10,000, $11,000 to risk 39. So almost 4 to 1, a little bit less than 4 to 1 risk reward ratio. Looks kind of good, but that is based solely on this, and that's why I hate the butterflies. I hate the butterflies, and the reason why is because in general, investors like the iron butterflies or butterflies because you're right at the money, so you get that at the money time value that we like to get when we're selling. You get the highest time value, and you're buying outside wings here to give you this coverage, whether you're doing an all call, all put, or something. But in general, my experience with the butterflies, and through testing and not really trading, but through testing a different management and some of the more condensed horizontal spreads, is that about 2% of the time you get close to this. About 5% of the time you're in this range. About 40% of the time, the stock will end in this range where you're at half of your expected expected profit. And then about 60% of the time you're here where it's not worth it. Little gain, little loss. I'm sorry, not 60. I meant 50. I'm sorry. And about another 5 or 6% of the time you're on these outside wings where you've taken the max loss. So let's say the loss is about here. So about 50% of the time you take a small gain or small loss. 40% of the time you don't make as much. Only 1 or 2% of the time you make this, and 5 or 6% of the time you take the full loss. Okay? And it's management intensive because no one does it that way. No one would enter a butterfly that I know of, that I've talked to over the years, with the expectation of just opening the trade and yes, my stock's going to trade right here. As it moves up, they're going to roll the short call. They're going to move the long call. They're going to move these legs. They're going to move these legs. They're going to constantly be adjusting the position. I personally don't have the time for that. And that's another reason why I don't do the horizontals, because it's management intensive and I don't have the time for that personally during the day, during the trading day. And I meet my goals with my other strategies. So that's just my concerns with the horizontal same strike spreads. I do prefer a calendar, a diagonal, I'm sorry. But but this is going to be expensive as heck. But I'm going to structure it differently. We'll go back to that 28 days. Let me turn off the screen very quickly so you don't see me scrolling all the way down. In this case, staying the 28 days, December 4th, I'm probably going to go slightly out of the money. Yeah, I like the 33.50. Slightly out of the money. Not a lot out of the money. Slightly out of the money. And we're doing November. Is that correct? So almost a full year, 378 days out. Now, the price points are going to kill me naturally. But I do want to be slightly in the money here. You know, we're about 33. So maybe a 31.50. It probably doesn't, I'm going to tell you right now, it probably doesn't have the delta ratio I'd look for. It probably doesn't have the debit to strike difference ratio I'm looking for, but I'm going to use it now. We're only 200 points apart, and I've got a much higher debit than that. Okay, so this is like the one I had in the coaching session. This looks terrible, and it is terrible. I wouldn't do this. Break evens are higher and lower. So I'm down to 31.58 for the lower break even and up to 37.25 for the upper. Still not that great. 24% return, similar to yours. Why is this not the position I want? And it's because whenever I set up a true diagonal spread, my net debit, the cost that I pay into the position, in this case, it's $483.15 per contract. This debit has to be less than my difference in strike prices. And here I'm only at 200. Okay, so I need this to be a 500 difference in strike prices for this debit to work with me. Similar to what we built on the fly, I think, on Craft. Right, I've got a debit of 350. Nope, I'm only 2 points apart. So what I'd probably do in this case, I know what I would do. I'd likely sell the 32.50 for December. I'm still going out. I have to go out to January to be fair. 27.50. That might be it, but that might be too deep in the money. But that's okay. Nope. Nope, just very, very close in that case. Okay, it's still above it. Why is that important? Because you see it trails off more, and eventually I will hit an upper break even. But this one, I'm not worried about Craft hitting 40 anytime soon. This is why I like this one, is that we don't see anywhere here to go back into the red yet. It'll still keep trailing off because my net debit of 527 is greater than the difference in strike prices. Pause for a moment before I get the follow-up questions. David does say, okay, Mike, thanks, got it. And we got some follow-ups here on William and Robert, I believe, related to calendars. Then we'll get to our other questions. On power options, of course, these things that I'm talking about, delta ratio, debit to strike difference ratio. This is what I have in my default searches that we use. Okay, I'm looking for a delta ratio of greater than 2, usually greater than 1.8. What does that mean? That means the in-the-money option I'm buying has to have a delta that's twice as high as the option I'm selling. So when the stock does move up 1 point, I'm getting more gain on my long than I'm giving back to my short. And the debit to strike difference ratio of less than 1. Is that important? Well, I don't want to look at Revolve here. Let me look at Toll Brothers. His premiums are kind of bad, but oh, they're so far out of the money. That's why. Let me isolate. This isn't the normal search I use. So let me isolate that. Range out of the money, less than 3. Okay, so let me just do that. Get some better positions here. Narrowed it down to 1. Cisco, and it's a weekly. But that's fine. Okay, let me show you why I'm doing this. See, it never, even going up almost double, up to 65 from 37, it never goes back into the red because the net debit was less than the difference in strike prices. Now, the key is, on any type of diagonal you look at short-term expiration, whether I'm doing this diagonal, buying in the money with the delta ratio, debit to strike difference ratio I wanted, or whether I'm doing a horizontal, the peak exists here right at the short-term strike price, and then it falls off after that at the short-term expiration. Why? Because as we get to the short-term expiration, something magical happens. When I opened this position, I had a delta ratio of 1.8 or 2 or greater, meaning that my long option, the delta of my long option was twice as high as my short. What happens at expiration? You know, here we sold roughly the 37.50, or probably the 38 or 39. I forgot to see what it was. Hold on 1 second. But what this is the magic at expiration. The 38.50. Okay, so we sold the 38.50. Once this short call goes in the money and I get close to expiration next week, what happens? My short option delta goes to 1. For every move the stock makes, I'm giving that back exactly intrinsically 1 or 2 days before expiration on my short call. Meanwhile, my long 27.50 option here is still probably at a delta of 0.8 or 0.85. Yes, it's deeper in the money, but it hasn't hit a delta of 1 yet. But because we're at expiration, our short option expiration magically goes to a delta of 1 or 0, whether it's in the money or out of the money. So I'm giving up more as the stock increases, and that's why it's not the covered call profit and loss chart. We have the same profit if the stock is anywhere above your strike price if you get assigned. It tails off now because we're only getting 80 or 90 cents here on our long. We're giving back 1 to 1 on our short. We're actually losing money as the stock increases in value. Of course, we'd be adjusting it at that point as well. Okay. All right. So I think these questions relate to one another that came in from Robert and William. I'll take Robert first. Okay, so that's my discussion there on why I prefer diagonals above the horizontals. It's not for everyone. Again, I encourage anyone that if you're, or you watch this later on YouTube, if you have a good approach that you're very successful with, or even if you're successful with it, you just want to talk about it regarding the horizontal spreads, the same strike calendar spreads, horizontals, let me know. Comment on it on the YouTube if you're watching it on YouTube, or comment right now if you're watching on the webinar. I don't know which one to take first, so I'm just going to take it in order. And Robert's follow-up question says, Mike, you're ahead of me. What if you're selling calls against 2-year leaps, a diagonal, as a follow-up to your covered call discussion? Same thing. All right, Robert, so where I was going with the management in this case, I sold the 38.50. I want as much as this 75 cents I can get on this position to lower my cost basis. So I treat my diagonals personally like I treat a covered call, or some of you are familiar with the married put structure, as the income method number 1 on a married put, which looks like a similar profit and loss chart, to tell you the truth. It's kind of a similar calendar, isn't it? I've got a stock, I've got a leap, or I've got an option that's 6 months out, okay? And I've got a short-term call against it. I see a very similar profit and loss chart when I create sort of that collar with a 5 or 6 month out put for my married put and selling a 2-week out or 1 month out call. I wait for it to go in the money. Okay, I wait for it to go in the money and then look to roll it. In the previous discussion on the covered calls, we were talking about why you don't want to roll for the sake of rolling. If this stock moves up to 38.20 next week, and I'm sorry, and because of that movement, even this is only a 7-day, this doubles and goes up to $1.20. Even though I'm at 30.20, I'm not worried about it because I'm still out of the money. I want to get as much of this 75-cent time premium as possible. So if this goes up because of the at the money bell curve rule, if this extrinsic value swells, even though we only have 4 days left to expiration next week, but the stock moved up to 38.20, I know it's only 70 cents, but let's say this goes to $1.10, I'm not worried yet. It's when it goes in the money. Maybe it goes up, I'd say in this case, if it went up to 39, that's when I'd probably consider rolling the position. Yes, it might cost me more. It might cost me 85 cents or 90, but I'm going to get more for the now at the money, 39 or 39.50, than trying to force it to go further out of the money, Robert. So as a general rule, I tend to let it go in the money. What I look for to potentially close it, if this is expiration day and the stock's at 38.20, for example, and just like in a covered call approach, if my time value is less than 1%, or I've made 80% of what I expected to make on this short call, that's when I'll look to roll it. Okay, if I'm at expiration, I'll roll it. Because my plan was to continue the trade, Robert, absolutely. So in this case, I'll keep rolling it. One thing in Robert's, I don't think I have it here. We might have to go back to, oh, we do, don't we? Fantastic. Let's go out. It's only 1 year, Robert, but let's go out to 2022 on this stock. Let's buy a slightly in the money call. I'm not sure if it's going to have the delta that I want, but let's stick with the 32.50 for 765. Why am I buying this far out? Well, as Robert mentions, if I buy further out in time, I get a lower cost per day. You see that? See, I'm paying $7 for 441 days at the 32.5 strike. At June, of course, it's not going to give me a 32.5, but at 33, half the time, it's not half the cost. It's not at 350, it's at 595. So I gained twice the amount of time to 441 days, and I'm only paying $2 to $3 more. Oh, I'm sorry, less than $2 more. It's not double. And if we look at standard January expiration, only 70 days away, okay, let's take an estimate here, $6 versus 510. So let's call that a midpoint if we had a 32.50 strike. Of course, of roughly about, what did I say, 510? Yeah, so roughly about 555. But 441 days out is only $7. I get a lower cost per day. But what you have to be careful with when buying 2 or 3 year out leaps and then trying to force a weekly sell or very short-term sell against it, let's keep the 38.50. Yeah, I'm getting a 10% against it. Okay, so we're going to buy this at around 7. We're going to get about 72 cents for our 38.50. Oh, shoot. I'm sorry, folks. Strike. The slope is difficult because of the high cost. So trying to force I know this isn't what your question, Robert, is. I'm just warning that although I get a lower cost per day buying a 2 or 3 year out leap, in this case, or 1 or 2 year out leap, let's really call it what it is. And we're looking at a 1 year out leap, Robert. Trying to force a weekly premium for a small amount just to generate income. It does give you more right cycles, an important term in the diagonal spreads, but you're getting about 10%, which is okay. You got a good maximum return here, but that slope falls off more quickly. You might want to go 30 days out or more to make up for it in that case, okay? All right. And then William's question here is, from a management perspective, how is managing a short call in a calendar position any different than managing a covered call on a long stock? To me, it isn't. I use the same triggers. I know this is the same question. I could have read them both at the same time, but to me, it's the same thing. I use the same triggers as I used to use with covered call trading. If the stock goes above my short call strike price, I let it go in the money a little bit. That's when I look to roll the position. I'm not worried, again, as we talked about on that previous covered call, that if I had done this earlier and only got 35 cents, 30 cents, and now the stock has moved up and it's at 75, it doesn't faze me that it's double what I collected, that the buyback cost looks like 100% loss because I'm still out of the money. I'm still primed to get the premium that I want if it stays below my strike price for the next 7 days to the 13th of November expiration. One thing that you might do want to consider, it's a little bit tougher with the diagonals, is that it's important to me when I roll, William, another step up, it's important to me that when I roll, I want to keep that debit to strike difference ratio that I mentioned. In other words, if this goes up to 39 and this costs me, for whatever reason, $2 to buy back, what's going to happen? Well, it's going to increase my cost basis up to $7.58. Okay? So let's say that I said it was at 39. So now if I sell a 39.50 call and get 30 cents, okay, so if I roll up to the 39.50 and I get 30 cents, that now reduces my new cost basis to $7.28. But I'm only at a strike difference of 7. Why is that so important? It's because if I'm wrong again and the stock suddenly goes up above 39.50 and I'm assigned, and now my broker exercises the 32.50 to deliver the short, I only get $7 back. I'm at a loss of 28 cents. My profit and loss chart might even look like this, but I'm at a loss. Why? Because this profit and loss chart, the profit and loss chart you see at your broker, is based on having the ability to be able to sell to close the long option for the remaining time value that it has. Okay? Go to 1113 here. So if the stock was at 39, 50 cents above our short call strike price next Friday on 1113, the theoretical value of our 32.50 is 953. That's $6.50 in the money. So there's an additional $3 of time premium that exists. If I allow my broker to buy shares of stock from me at 32.50 to deliver my 38.50, what am I getting back? $6. The expected value is $9.53. $6 of that is intrinsic. $6.50 is intrinsic. The remaining $3 is time value. If I allow this to be exercised to deliver the short, I'm denying myself the time value that still exists in that position. That's one of the other rules. All right, we're going to stop there because it is 5:30. No, we've got plenty of time. So Emilio and Alberto, I'm getting to you, and William, you've got your other question. But we're going to stop on that discussion for now. Later on, if you go to the free webinars page, powerop.com/webinars.asp, go into option strategies, scroll down in the option strategies, and I just looked at this last week, if I'm not mistaken. Here is a one for good candidates for a poor man's covered call. We talk more about that criteria and what we look for. And then further down from 2019, if I'm not mistaken. Come on, where are you? 2017? Oh, there we go. Calendar spread basics. For those of you that might have been a little bit lost, this is a good starting point. It talks about defining horizontal versus diagonals, proper structure, specific terms, very important. Different than a covered call. There's 3 to 4 very important terms you're not used to with a covered call that you'll have to use in the diagonal spread or the horizontal spread that are very important. We talked about delta ratio, debit to strike difference ratio, right cycles. These things are a little bit more important that you don't get into with the covered calls too much, but are essential for the calendar spreads. And then again, the calendar spread criteria. If you are just getting introduced to this and you like what you've seen, this is appealing to you about the diagonals, check out calendar spread basics, and then go up here to that other one that's more recent. I thought it was a really, really good discussion we had a couple weeks ago, if I'm not mistaken, a year ago. Good candidates for the poor man's covered call. They all run together from time to time. Sorry about that. So that's a really good one to take a look at too for the type of criteria that we're talking about. That's in the option strategies section as well.